The 7 things to be aware of in the stock market. That is what I want to talk about today in this video. So the 7 things that you should be aware of if you are a stock market investor. Number 1, fund managers publicly talking about a company. So let's say I am a fund manager and I have invested in a company. So I go out and publicly talk about my holdings, whether it is on YouTube, whether it is in some event, or whether it is in some conference, or whether it is on business news channel. If I am an influential fund manager, you need to be aware of this thing because there is a direct conflict of interest here. If I am an influential fund manager and if I talk about which stocks I have bought, then obviously people are going to get influenced by my opinion, and obviously they are going to buy the stock and bid the stock price up, right? You have to understand that back in the day, in the 60s, early 60s, when Warren Buffett was managing a fund, a kind of a mutual fund for his limited partners, even his limited partners did not know where their money was getting invested. So Warren Buffett was so secretive about his investments because he knew that if he spoke about his companies, his holdings, then other people will bid the stock price up, and he wouldn't be able to buy bargain stocks at a bargain price. So I see this happening in the stock market time and again. Fund managers are publicly disclosing their holdings. I feel that this is not right. Fund managers can talk about the concept, they can talk about the fundamentals, they can talk about a business, but directly sharing what they have in their portfolio and then talking about the business in a way that it is compelling for the listener to invest, I feel it is not right. There must have been a reason why Warren Buffett, Charlie Munger, people like this were secretive about their investments, because they wanted to take hold of that opportunity. They did not want to give that opportunity to someone else. That is how investing is done. That is how real investing is done. Talking about investments and then expecting other people to invest in the same stock so that the stock price gets bid up. I think there is some ethics related issue here. I feel this is not right. So you as an investor must be aware that if a fund manager starts talking about his holdings, you need to understand that there is some conflict of interest there. You should be careful about investing in that company. You must do your own due diligence. No doubt the company can be good, but do your own due diligence. Number 2, YouTube influencers publicly talking about their stock holdings. The same concept applies, whatever applies to fund manager, the same thing applies to a YouTube influencer. If I am a YouTube influencer, I have 1 million followers and I talk about the stocks that I have bought, then obviously people are going to get influenced and they might bid up the stock price. I feel this is not right, and YouTube influencers must not share their stock holdings. See, the problem is, if you buy a stock that your influencer has bought, what if he sells the stock after 2 months, 3 months? Is he going to come and tell you that he has sold the stock? The chances of that happening is very less. So you have to take responsibility for what you are investing in. Number 3, the PE multiples of stocks on information providing websites. See, there are a lot of information providing websites where you can see the balance sheet, the profit and loss account, the cash flow statements and things like that. You will also find the PE multiple there. Now, that may or may not be the right PE multiple, because let's say there is a company and it sells a particular subsidiary and there is a huge windfall cash inflow and it is reported as a profit. So suddenly you might see that 1 year the profit is 50 crore. The next year suddenly the profit has gone up to 500 crore. And that's why the PE shrinks. So the PE might go from say 20 to 5. Okay. So now you might feel that the stock was selling at 20 times earnings. Now it's selling for, let's say, 3 or 5 times earnings. So it is a cheap stock and you go out and buy the stock. But in reality, if you closely look at the profit and loss account, maybe there is a one-time gain that is coming in. So you have to watch these PE multiples carefully. calculate your own PE multiple. Another thing that can happen is a company is sitting on a lot of cash on the balance sheet. So you have to deduct that cash from the market value of the company, and then whatever is the remaining market value, you compare that with the earnings. That is the real PE multiple, assuming that the company is debt free, of course, because this cash and these investments are lying idle with the company. So it is not a part of business. Maybe the company doesn't need that cash or those investments. So from market cap, you can reduce the cash equivalents and you can reduce the investments done in mutual funds or fixed deposits. And then whatever is the remaining market value, use that to calculate your correct PE. Maybe the PE multiple is really low. So you have to adjust the PE multiple. So the PE multiple that you see on the information providing websites may not be the accurate PE multiple. Number 4, free cash flow versus profits. You have to look at the free cash flows of the companies. You have to look at the profits of the company. There are cases where the company is reporting profit year after year, but there is no free cash flow. Maybe because whatever money the company is earning in profits, it is getting reinvested back into the business to buy some fixed assets. So basically there is no free cash flow remaining for the shareholders. So just because a company is profitable doesn't mean that it is making money. In fact, it might be losing money. Number 5, management interviews on business news channels. See, if I am a managing director of a company and if a business news channel is interviewing me, what are the chances that I will speak ill of the company, or what are the chances that I'm going to say that my company is not going to do well in the next 2, 3, 5 years? The chances are very low, right? Because I have to report to my board of directors. I have report to people who are above me in the company. And if I sound pessimistic on a national business news channel, then it doesn't go down well with my superiors, even with the employees. I have to be the leader. I have to be the manager. I have to take responsibility. I have to be optimistic. So the management of the company is always going to talk positively about the company. So you have to take this into account when you are listening to a management interview. Look at facts, don't look at the opinion. Look at facts, don't look at the future guidance. Read the annual reports of the company, that will give you the real data. Number 6, the stocks of big investors. Let's say there is a stock and some big investor has invested in that company. So big individual HNI investor. So just because this HNI investor has invested in the company doesn't mean that you have to invest in the company as well. Maybe the HNI has some information. Maybe he has access to information that you do not have. Let's say there is a billionaire. He can just make a few phone calls and find out about the company. He can put 10 people to research that company. Do you have those kind of financial resources and manpower to do that kind of due diligence or research? You don't have that. So if you have not done due diligence on a particular company, it does not make sense for you to invest in that company just because some big investor has invested. I have seen companies where the company does not have free cash flow. Forget about free cash flow. The company does not have even operating cash flow. Still, big investors are investing in these companies. That means they know through their professional network of contacts which they have built over decades, they know something about the industry. They know something about the company which is not published anywhere. They have this information which they think is relevant and which might positively impact the share price of the company. You don't have access to that kind of an information. So that means your due diligence is not complete. So you have to be aware of this. Just because some big guy is investing doesn't mean that you have to invest blindly. Because what if he exits the company? Is he going to tell you that he has exited the company? And even if you get to know that he has exited the company, you will get to know it after the fact, right? Number 7, valuations of growth companies. See, just because a company is a growth company doesn't mean that you invest in that company. Benjamin Graham has said in his book, The Intelligent Investor, that obvious prospects for physical growth in an industry does not mean obvious profits for investors. Obvious prospects for physical growth in an industry does not translate into obvious profits for investors. This is Benjamin Graham saying in The Intelligent Investor. So just because a company is growing doesn't mean that you have to invest in that company. The chances are everybody knows that the company is a growth company and everybody has invested in the company and the company has now become overvalued. So a great company may not be a great investment. So these were the 7 points that I wanted to discuss. As a stock market investor, you should be aware of these 7 points. Thank you so much.